Good afternoon, ladies and gentlemen. I'm Nancy Hancock with the Investment Advisor Association. Welcome to our webinar, Understanding Blockchain and Digital Assets. During the webinar, all participants will be in a listen-only mode. You may submit questions to our speaker at any time during the webinar by typing them through the chat feature. Only the speakers will see your questions. We'll address them as time allows. And as a reminder, today's webinar is being recorded June 23rd, 2021. Now it's my pleasure to introduce you to today's speaker, frequently described as one of the most influential people in the financial planning and investment management profession, Ric Edelman. Ric has been ranked the #1 independent financial advisor in the nation by Barron's 3 times. He's founder of Edelman Financial Engines, the largest independent RIA firm in the country, and of RIA Digital Assets Council, or RIA, an organization committed to educating advisors about blockchain and digital assets. Ric, we are delighted to have you with us. Thank you. Over to you.
Thank you so much, Nancy. I appreciate the introduction very much, and we're thrilled to be part of this event today, and thank you so much for joining us. I got to come clean with you, though. I don't think anybody is really happy to be talking about this subject. I'm not really happy to be having to be dealing with this subject. Why are we doing it? Because there's really no choice. We're all running successful organizations. Clients are happy. The financial markets have been doing extraordinarily well over the last 40 years plus, ever since we got out of the recession of the 70s. Why do we need something new and different? Why do we need to talk about blockchain and digital assets? And isn't life just fine without it? So I think we'd all rather be not having to deal with this. But unfortunately, this is the situation. We have no choice as financial professionals to be acknowledging the existence of this and to figuring out what it is. Does it have any application for our firms, for our advisors, for our clients? And if so, what are those implications and what are the applications? How can we guide ourselves and our careers and with our companies as well to be able to manage all this effectively? And that's why we're here today. So I'm kind of grudgingly here along with you, and I kind of grudgingly created RIA, the RIA Digital Assets Council, 3 years ago. Like you, I come from the financial world. I am an advisor. Many would say the #1 advisor in the country, having created Edelman Financial Engines, the largest and most successful RIA in the country with $270 billion in assets. You may have heard the announcement that I'm leaving EFE at the end of this year after founding it 36 years ago with my wife, Jean. And one of the reasons is the company is very large and successful and really doesn't need us anymore. And what we are going to be focusing on are areas in the financial community where there is a need. And a big one is in this subject of blockchain and digital assets. I've been involved in this space since 2012 and have learned over the years a couple of primary facts. Number one, this subject of blockchain and digital assets has the potential to be the most transformative new technological innovation since the invention of the internet itself. And second, most financial professionals aren't aware of that fact. And so I created RIA as an educational organization designed solely to provide knowledge, information, education to financial advisors and executives in advisory firms. And that's what I'm going to walk you through today. I'm going to blow through these slides. There's about 100 of them, but don't worry, I'm going to blow through them really fast so that we can spend as much time as possible in Q&A. So with that as a backdrop, let's jump right into this. And I do want to identify as a first step what many consider to be the 4 most important developments ever in the world of global commerce. Number 1, as fundamental as it gets, the discovery of fire and the application into business development. Number 2, the wheel. Number 3, the internet. And number 4, the blockchain. Now, if that kind of freaks you out, wondering how we could possibly put blockchain technology at the same level of fire and the wheel, Well, stay tuned. Why is it such a big deal? Well, PwC says blockchain tech is going to add nearly $2 trillion to the global economy this decade. The Bank of England says blockchain could transform the global financial system. Already, 90% of the world's banks are testing blockchain applications. It's expected to cut their costs 30%. Half of the nation's top 50 universities are teaching digital assets and blockchain tech. You can now get college degrees in this. And engineers in blockchain are now the highest paid in all of software development. NASDAQ, for one illustration, says that blockchain technology holds great promise in allowing capital markets to operate more efficiently with greater transparency and security. And it's not just the financial marketplace that is impressed with this. As diverse a business as Hollywood and the recording industry, Billboard magazine says that blockchain can deal with song rights monitoring and distribution of royalties and events tickets. Well, what makes it such a big deal? Well, understand the way that we manage data and money. With traditional ledger systems, when you record entries in your checkbook, that's a ledger system. When you deal with the traditional ledger system, the access is restricted. Permission is required. You are the only one who has your checkbook. Your CFO has access to the company's financials. Nobody else does. It's restricted permission. That allows data to be manipulated. We always have heard of the mafia with two sets of books. One they show the government, one they don't. The data can be manipulated in traditional ledger systems. That leads to fraud and abuse. And finally, traditional ledgers are expensive. They're privately owned, and that control produces costs. But blockchain technology, also known as distributed ledger technology, is very different. The systems are open to everybody. Access is not limited. The data is immutable. Once data is placed onto the blockchain, it can't be ever changed or copied or erased. And the access is completely free. This is revolutionary. The bottom line is this: blockchain technology eliminates what's known as the trust industry and creates the authentication industry. Let me illustrate for you what I mean. This was the very basis of the creation of blockchain and Bitcoin. Satoshi, nobody knows who Satoshi is or was. Satoshi invented blockchain technology and Bitcoin in 2009, and in Satoshi's white paper said what's needed is an electronic payment system based on cryptographic proof instead of trust. Let me just illustrate for you what all this means. There are thousands of use cases in global commerce that drive the interest in all of this. Here's just one simple example. Your house. Your house, your ownership of your house is represented by the deed to that house. Well, connected to your house in any transaction involving it, you have the seller and the buyer. So each one of those three are separate and distinct. The seller wants to convey the deed to the buyer, and so they are three separate links. And blockchain technology connects them together. And that's why it's known as a block of chains, or the blockchain. It's really that simple. But here's what's so fascinating. Because we can put the deed onto the blockchain, this is now immutable. There is only one deed of your house. It is connected to you. Picture an Excel spreadsheet where you have you in one cell, the deed is in the cell right next to it. Once the data is entered onto the cell, it can never be changed, can never be altered, can never be copied, can never be deleted. It's immutably connected to you. And when you have a buyer going into the cell next to the deed, that too is a permanent entry. Therefore, nobody has to trust whether the transaction is legit. It's there permanently for all to see forever on the blockchain. That means you don't need title insurance. We all know that we spend thousands of dollars in title insurance, in title settlement costs. It takes 90 days or more from the time we sign the sales contract to buy the house to when the transaction settles, because it takes so much time to verify, validate the transaction, the deed, you buy title insurance in case something goes wrong. The blockchain eliminates all of that. It's no longer necessary to trust the seller that they truly own the deed and the deed is legitimate. It is now authenticated, and that is revolutionary. In other words, the trust industry is just a bunch of middlemen, or as I heard somebody once say, parasitic middlemen. That trust settlement attorney isn't adding to the value of the house. They're just charging a fee for the privilege of being able to get involved in your transaction. Parasitic middlemen. There are an awful lot of industries where we have middlemen, where you have somebody in between the buyer and the seller. There are 10 million people in the United States working in those industries, 21% of our GDP, and the blockchain can automate all of their services. This has huge implications for global commerce, huge implications for careers, and also massive investment opportunities. Blockchain, as I mentioned, was invented by Satoshi to allow for the creation of Bitcoin. Bitcoin is not issued by any government. It's inflation proof because there's a fixed number of coins, 21 million. That's it, never any more than that. So it's inflation proof, unlike the dollar, which can be printed over and over again, as we've seen in the past year in fighting the pandemic. The transactions involving Bitcoin are highly secure, virtually instantaneous, and free. Thousands of commercial applications. I've shared one with you already. Let me give you another. Cross-border payments. This is a very big business. According to the World Bank, $4 trillion every year moves from one country to another. And not just by big business moving money in corporations across borders, but individuals as well. We have millions of immigrants here in the United States, for example. They often have family in what my grandmother used to call the old country. As immigrants come to the US and they leave behind their parents or siblings, and many of those immigrants, as my grandmother used to do, sent money back to the old country. In her case, she sent money back to Russia. Well, when you're going to engage in this $4 trillion a year, according to the World Bank, the average transaction to move money from New York to London takes 5 days and costs 6.5% in commissions and expenses. With Bitcoin, you can do it in 10 minutes, virtually free. This is revolutionary. There are now tens of thousands of merchants who will accept Bitcoin in payment. With Bitcoin, you can make charitable donations. You can make political contributions. And in Ohio, you can even use it to pay your business taxes. Is this a fad? Is this something that we don't really have to waste a lot of time on because it won't be here for much longer? Well, consider Bitcoin's market cap is already bigger than JP Morgan, MasterCard, Disney, and others. The annual transaction volume is huge. Bitcoin did $1.3 trillion in volume last year. That's twice as much as PayPal, 6 times more than Discover. And the controller of the currency is busy approving banks to accept and custody digital assets. They've just approved earlier this year the first digital bank, Anchorage. Goldman Sachs and Bank of New York both say that they're going to begin custodying digital assets, along with Morgan Stanley and others. Who's buying Bitcoin? Well, individuals are, 100 million of them worldwide, including 17% of American adults. 63% of American adults are self-defining themselves as crypto-curious, meaning, I don't know what this really is, don't really understand how it works, not sure if I should be involved, but I'm curious, I want to learn more. When you've got 2/3 of Americans wanting to learn more, clearly this isn't something that we can ignore. In fact, Coinbase now has more account holders than Schwab. And Schwab, when you look at the top 10 holdings of millennials, the Grayscale Bitcoin Trust comes in at number 5. Millennials own more Bitcoin than they do Berkshire Hathaway's Disney, Netflix, Microsoft, or Alibaba. Something's going on here. Money managers are buying digital assets. 94% of them say that they hold assets. University endowments as well have said that they're buying digital assets. So are lots of billionaires. And major corporations today are buying digital assets as well. In fact, as you saw from preparing your tax return earlier this year, it is now the number one question, the very first cue that the IRS asks on the 1040. After you provide your name and address, they want to know at any time last year, did you send, did you receive, sell, send, exchange, or otherwise acquire any virtual currency? Why would the IRS be putting that as the very first question on the tax return, unless it's something that they feel an awful lot of Americans are getting involved in and simultaneously not declaring on their tax returns? There's massive growth predicted. Many argue that we're just still in the very early stages of this. Deutsche Bank says by 2030, cryptocurrencies could replace cash. Visa says we want to provide digital currencies to our 61 million merchants. MasterCard says the same way, we're creating secure experiences in today's digital economy. PayPal already allows its 325 million users buy Bitcoin. A third of them have already done it. And they can now use it to buy goods and services with PayPal's 24 million merchants. Abby Johnson at Fidelity says, our goal is to make Bitcoin more accessible to investors. George Ball, the former chair of Prudential, says, digital assets are very attractive. Larry Fink, the CEO of BlackRock, says Bitcoin is here to stay. And Rick Reeder, the CIO of Fixed Income, says Bitcoin could rival gold as a primary store of value. And Neil Ferguson, the professor of economic history at Stanford, says coming out of the pandemic, the best investment opportunity will be Bitcoin. Tiburon Strategic Advisor says the price is going to be $150,000 by the end of this year. Bitcoin's currently around $36,000. Citibank's head of technicals, Tom Fitzpatrick, says it's going to be over $318,000 by this year. Guggenheim says 400,000. ARK Investment says 500,000. There are some lofty predictions being made about the future price of Bitcoin. And the Association of Governing Boards of Universities and Colleges says cryptocurrency has already produced hundreds of millionaires, a number of billionaires, and may produce the world's first trillionaires within the next decade. Why would they care? Why would this be the focus of a cover story in their member magazine? It's real simple. Universities and colleges are always looking for donations from their alumni to support their endowments. You go to rich alums to go get lots of donations, and where are those rich alums getting their wealth? Increasingly from digital assets. How about investment advisors themselves? Are they adding Bitcoin to client portfolios? So far, 6% of them have done so. 45% say they plan to do so in 2021. The number one reason advisors like Bitcoin and digital assets, it's not because of the price potential, it's because advisors believe in diversification. And Bitcoin has demonstrated a low to no correlation to other major asset classes. This is the first truly non-correlated asset. And any advisor who strongly believes in diversification loves the idea of adding an asset into the portfolio that helps to reduce the risk while providing an opportunity for return. It isn't price potential, it's low correlation that has advisors interested. But what about volatility? Well, in 2020, 30% of the stocks in the S&P 500 were more volatile than Bitcoin. So we need to put all of this into proper context. We don't avoid stocks because they're volatile. We acknowledge it's just an inherent nature of the asset class, and we adjust the portfolio allocation accordingly. Same thing with digital assets. So I want to ask you 3 questions. When I do this in live events where we can interact with the audience, we're able to bandy about the answers back and forth. I think I'll summarize for you what I think you're going to say the answers to these questions are. Let's see if you agree with me. Here's question number one. What average annual return would you expect from a typically diversified portfolio over, any reasonably length of period of time, 3, 5, 10 years, what have you? What average return would you expect? When I ask that question in seminars, the audience typically says 6, 7, 8% per year. Well, let's go with something like that. Question number two. In 2017, as you may well remember, Bitcoin rose 1,500%. Unbelievable. And then the following year, it crashed 84%. We saw a similar rise in the past 12 months, followed by a recent crash in Bitcoin. Could something like 2017, 2018 happen again? I think we would all agree that the answer is yes, it certainly could. We would all know it's happening right now. And question number three, could Bitcoin fall to zero, become worthless, and stay worthless? Again, I think we would all have to agree that the answer is yes, that certainly could happen. Now, with these answers in mind, I want to show you some data. I want to show you the impact of digital assets and the power of compounding. We're going to look at 3 investment portfolios over a 2-year period. The first one we'll label a typical portfolio 60-40, nothing unusual in that regard. 60% stocks, 40% bonds. I'm now going to show you 2 additional portfolios. Both of them have the same allocation. Instead of 60-40, they are 59, 40, and 1. We are going to place a mere 1% allocation to Bitcoin. And in the first portfolio, we're going to call it a wave and crash, meaning it's going to enjoy that 2017 1,500% gain, followed by the crash a year later of an 84% loss. The second version will be the total wipeout, a portfolio that becomes worthless. Watch what happens. In year 1, our 60-40 portfolio rises 7%. Kind of routine, as we described, pretty routine rate of return for a 60-40 portfolio. These are all, I hasten to add, hypothetical numbers. We're not suggesting that this is representative of any real or actual investment results. I'm simply trying to get the point across about the impact of the power of compounding. The second portfolio, which has a 1% Bitcoin allocation, enjoys the wave, a 1,500% gain in value. Look at that. The portfolio ends up with a 22% return. A mere 1% allocation triples the total return of the overall portfolio. And our third portfolio, the 1% allocation to Bitcoin becomes completely worthless. The portfolio ends up with a 6% gain. Now, imagine talking to a client in your firm. Which of these 3 portfolios would they like the most? Silly question, isn't it? I'm kind of cheating here. Obviously, we'd all love the 22%. But look at the portfolio that went be completely worthless. Instead of earning 7, you only earn 6. And that's my point, is that even a complete wipeout is not going to make a client particularly angry over this if the client has been correctly educated and vetted and understands the nature of that risk. But let's keep in mind, we've only gone through year 1. Let's look at year 2. In year 2, the 60-40 portfolio now has a total return of 14.5%. We've compounded the first year's return. The wave and crash portfolio, well, we enjoyed the wave. Now it's time for the crash. And even after losing 84% in value, the total return of the portfolio is still 15.4%. And the portfolio where Bitcoin blew up worthless, the total return is 13.4. Do you see the implication here? Even though Bitcoin enjoyed a wave and a crash, it still has the highest 2-year total return. And the portfolio where it became worthless, it was less than a 1% differential from not having invested at all. And that's my overall point here. I'm not suggesting that investors are always going to get in on prior to the wave and avoid the crash itself. That's not my point at all. My point is that we don't need to allocate a substantial amount of money to this new emerging asset class. In fact, this is counterintuitive to most of us. Most of us have been in this business a very long time. Our career's been devoted to this. I've been doing this for 36 years. Many of you have been doing this for 10, 20, 30, 40 years or more. And what we have learned through our careers is that when you're going to create an asset allocation model, if you're not going to allocate a meaningful portion of the portfolio to an asset class, there's no point in doing it, which is why we routinely do 10, 20, 30, 50% of assets in a given asset class, a 40% allocation of bonds, a 60% allocation of stocks. I mean, what good would it do you to own one share of Microsoft? Wouldn't make any difference. If you don't have a meaningful allocation, why bother? But this asset class has proven itself to be different because of the incredible volatility, which is far greater than we normally experience in the stock and bond and real estate markets. A 1% allocation has the potential to generate a material impact on the return. But if something goes wrong, and let's face it, something could easily go wrong, a 1% allocation isn't likely to cause a material level of financial harm. And this is why I'm the guy who's been the proponent of the 1% Bitcoin allocation for many years, because it's a different approach. We don't have to take a big risk to enjoy an outsized return. The diversification benefit of this non-correlated asset can improve the overall results of the portfolio in a meaningful way with a mere 1% allocation. I'm not the only one saying this. Yale in 2018 produced its own paper, and they said in their paper, if you believe Bitcoin will outperform annually by 30%, you should allocate 1% of the portfolio to it. If you think Bitcoin will outperform by 50%, you should allocate 1.6% of the portfolio. If you think the portfolio will outperform 100% with Bitcoin, you should allocate 3.1%. 200% outperformance, 6.1. And if you think Bitcoin will only do half as well as it did before, 3.1%. Even Yale's academic paper acknowledged there is no reason to get overboard with this asset class. We don't need to do 10, 20, 30% of investment allocation in this space in order to have a material impact on the overall results of the portfolio. A 1%, 2% allocation for appropriate clients where it's in their best interest is plenty. Right now, though, what we have to understand is that Bitcoin is just the beginning. I've been using Bitcoin as a colloquial phrase for the entire digital assets environment. There's distributed autonomous organizations, DeFi, decentralized finance, NFTs, of course, non-fungible tokens have gotten a lot of attention in the past few months, central bank digital currencies, CBDCs, all of this and more is coming. Back in 2018, just to give you an illustration, was the first such transaction. A condo building in Manhattan worth $30 million was tokenized on the Ethereum blockchain. Wouldn't it be cool to buy real estate? Wouldn't it be great to own the Sears Tower or the GM building or the Empire State Building? Well, the problem is most investors don't have a few $1 billion to invest in a major piece of commercial real estate. But what if we were to take that real estate and slice it into tiny pieces worth $10 each? Think about doing this with your house. You got $1 million house? Slice it into 250,000 slices of $4 each. You can't sell your kitchen to generate income in retirement, but you could certainly sell shares of your house. We have pro athletes who are doing this today, tokenizing their contracts. We have recording artists who are doing this. Stevie Nicks did it. Bob Dylan did it. David Bowie did it. He was the first one before his death. We have the opportunity to tokenize everything. And once we do that, we open up the marketplace to an incredible new array of diversification opportunities. Because as big as the US stock market is, in fact, the global stock market at $100 trillion, the global real estate market is 3 times bigger. And that is why you're seeing artwork being tokenized as NFTs, rare cars, rare wine, anything, everything can be tokenized, creating massive new investment opportunities in time to come. Because the digital asset universe is massive. Satoshi invented the blockchain, and that allowed for the creation of Bitcoin. Bitcoin today is only one of several in what is considered layer one of the digital assets universe. Ethereum is the second largest. Polkadot and Algorand are growing very quickly. We then have the second layer, scaling, where you have other protocols being developed to make improvements on the layer one. Bitcoin is wonderful, but it takes 10 minutes to settle a transaction. Along comes the Lightning Network, which can do in seconds what takes Bitcoin minutes. Then you have Web3 applications. This is where you find DeFi and NFTs, CBDCs and stablecoins and DAO. You're going to have very few players ultimately in layer one. You'll have dozens in layer two, hundreds in layer three, and finally, when you get to layer four, you'll have thousands. The analogy, layer one is like your smartphone, and you don't have very many players. You have iPhone and you have Android, but by the time you get to layer four, those are the apps, and there are thousands of apps for those phones. All of these represent transformational opportunities in global commerce and simultaneously significant investment opportunities as well, along with significant traps that we must protect our clients from. So how do you engage in this on behalf of your firms, and how do you construct portfolios that add digital assets? Well, already in Canada, they do have ETFs. There are 4 companies offering them. In the US, there are publicly traded securities. MicroStrategy is now widely regarded, although technically it's a software service company, it's now widely regarded as a proxy for Bitcoin because they have $4 billion worth of Bitcoin in the portfolio. Tesla as well. There is also an ETF from Simplify, which is got an allocation of 100% into the S&P 500 stock index with a 10% overlay of the Grayscale Bitcoin Trust. This is the first ETF in the marketplace in the US with direct access to Bitcoin, already publicly available. And there are a wide variety of publicly traded securities. Grayscale offers a wide variety, as does Osprey and Bitwise. In fact, Bitwise has the first diversified fund, the top 10 crypto index fund. Of the top 10, they consider it the S&P 500 of crypto, so to speak. Disclosure, I'm an investor in Bitwise. You also have SMAs and TAMs, a dozen different organizations providing these services, allowing financial advisors to provide digital assets to clients within a construct already routinely used in the advisory space. There's a variety of funds for accredited investors. And the world of picks and shovels. Many are saying, look, investing in Bitcoin is rather scary. I'd rather invest in the ecosystem. It's kind of like the Levi Strauss approach. It's instead of mining for gold in the California gold rush, let's manufacture blue jeans. Let's offer the picks and the shovels to the miners instead of engaging in mining itself. There are already a variety of ETFs available in the US that invest in the companies that are developing blockchain technology or the accounting or support systems that industry is using. Many consider a safer play than trying to get rich by buying Bitcoin itself. There are also private funds that do this in addition to ETFs, again, for accredited investors. In other words, there are a wide variety of investment opportunities available right now. There's no particular need to have to wait for the SEC to approve a Bitcoin ETF. By the time the SEC gets around to doing that, which many consider won't be for 9 to 18 months or longer, what will the price of Bitcoin be by then? And how much upside will clients be missing out on? These current investment opportunities argue we don't have to wait any longer. In fact, we can even now invest in digital assets inside of an IRA, a variety of companies, most of them qualified custodians, enabling us to place client assets into this new asset class. Indeed, it's time for financial professionals to learn how to get off zero. And to help you learn more about this, RIA has created the industry's first certificate in blockchain and digital assets. It's designed specifically for financial professionals. It's an online, self-study, self-paced course that offers 13 CE credits. We've built a world-class faculty, including Scott Stornetta, the co-inventor of blockchain technology. We have on the faculty folks from MIT and the Federal Reserve. The course is split into two parts. The technology is the first part. What is Bitcoin? What is blockchain? How does it work? What's the tech? What are the real world use cases? The second half of the program is entirely about practice management. What's the investment thesis? What are the investment opportunities? How do you construct a portfolio? What are the regulation and taxation of this new asset class? What about operations, compliance, and risk? And how do you explain this to clients, both current and prospective ones? So I encourage you to learn more about the certificate in blockchain and digital assets to help you in your own development and to help you and your firm figure out how to engage in this. This asset class isn't going away. And the biggest problem we have today is that there's still a number of aspects where it's a bit of a Wild West environment. Consumers are increasingly curious about this, and they are naturally turning to their financial advisors, those in your organization. Right now, most advisors don't have the knowledge to be able to effectively assist their clients, and they don't have the ability to make investments with them in this space. This is forcing those investors to go elsewhere, where unfortunately, too often, bad things happen because of this Wild West environment. Better for us as investment professionals to learn about this space, figure out how to adapt it within our practices in an effective and compliant manner so that we can protect our clients from what otherwise may befall them. I'm really excited to have been able to be here with you. Thanks so much. And we've got plenty of time now for the Q&A. So Nancy, I'll turn it back to you.
Thanks, Rick. So interesting. And we do have several questions. And so let's start off with a couple of questions about Bitcoin mining. What are the costs of Bitcoin mining? And when Bitcoins were created, they were mined through computer-driven algorithms, and new coins or fractional coins were allocated to the miners. Has Bitcoin mining, the creation of new coins, been stopped? I know you mentioned that there are a finite number. Do you want to elaborate upon that a little bit more?
Sure. Let me mention two things as a prelude to that. Number one, Nancy is going to tell you in the next week or two, I think, you're going to send out an email to your members that we're going to be providing through your membership here at IAA a discount for you when enrolling in the certificate program. So you'll be able to get your certificate through a discount as a result of our relationship with Nancy and the Investment Advisors Association. So watch out for that. We're very excited about our partnership. Second, in a couple of weeks at RIA, we are doing a 1-hour webinar on Bitcoin mining. So I will answer briefly for you here the info on mining, but if you really want to deep dive into what is mining and how does it work, I encourage you to attend our webinar, which is free, and you can learn more about that at riadac.com. So you're right, mining is where it all starts. What is mining? Well, the analogy would be picking apples in an orchard. You can go walk into the forest, find an apple tree, and grab the apple, and it's free, except for the amount of time that you have to spend to go get the apple. And maybe there are costs. I mean, you got to buy a ladder to be able to climb the tree to go get the apple. So there are some expenses and there's some hassle and some time involvement. Wouldn't it be easier just to buy the Bitcoin? Well, that's what most people do today. They go, just like you buy the apple at the grocery store, you spend money, you got to pay for the apple, but it's faster, it's easier, and your time is worth more than the hassle of walking into the orchard. So that's how most people obtain their Bitcoin. They buy it. They go to an exchange, and there are dozens of exchanges where you can do this. Everybody from Coinbase to Gemini, Kraken, PayPal. You can buy Bitcoin lots of places. But mining is free. And how does it work? Well, you get a computer. You use your computer and go onto the Bitcoin blockchain. Anybody can do this. Doing it is free. And when people put data onto the blockchain, we have to make sure the data is legitimate. We have to make sure you're the first person putting the data onto the blockchain. We don't want duplicate entries. So that's what the mining process is all about. It's an engagement where the Bitcoin miners are verifying that the data going onto the blockchain is legit. Well, that takes effort on your part. You got to buy the computer, you got to go into the software, you got to do the algorithm. That's a lot of effort and hassle. Why would you bother? Well, the incentive is if you validate the data, you are rewarded by getting Bitcoin. The reward you get today is 6.25 Bitcoin. Remember I said earlier, those are validated every 10 minutes. So for 10 minutes worth of work, you get 6.25 Bitcoin. Today, at $36,000 a pop, we're talking almost $250,000 for 10 minutes worth of work. That's a pretty good incentive. And that's why there are so many people engaging in Bitcoin mining today. So that's really the simple answer. Now, because there's so many people engaging in Bitcoin mining, it's popular. And that means there's a lot of competition. You're all competing with each other to be the first to validate the data so that you receive the Bitcoin. And because of that, people are buying lots of computers, entire arrays of them, really fast computers, because whoever computes it fastest wins. And that's why you're seeing these incomplete data mining farms. Go Google that, Bitcoin mining farm. You'll see amazing photographs of these massive buildings that have just arrays of computers in them, all in a desire to validate the data first. So what I would recommend, unless you are a hobbyist and you want to be a miner, you can invest in a Bitcoin mining company. Riot Blockchain is the first publicly traded Bitcoin miner. So you can buy stock in Riot Blockchain, or you can put money into a private fund for accredited investors that invests in mining operations. So that's the picks and shovels kind of thing. Instead of investing in Bitcoin, you invest in mining.
Interesting stuff. Another question about Bitcoin's market value. What drives Bitcoin's market value other than speculation?
Yeah, this is the thing that drives us all crazy. Let me just say this. I've been doing this for 36 years. I have 6 professional designations, managing $270 billion at Edelman Financial Engines, 1.3 million clients. I've written 10 books on personal finance. So I'm one of you, meaning, like you, I got a lot of experience, a lot of expertise. I've been through every bear market since the crash of '87. Been through every crisis our nation has experienced along with you. Here's what I've learned. The more knowledge, the more experience, the more professional designations, the more licenses. I'm a FinOps professional and held the fancy FINRA licenses as well as the SEC and all that like you do. The more college degrees you have in economics, business, finance, the more of that you have, the harder it is to wrap your head around this, because this doesn't make any sense. Bitcoin has no earnings. There is no product. There's no company. There's no business plan. How could this be worth anything? Who's doing this? There is nobody, because it's decentralized. It's instead of anybody, it's everybody. It's crazy. How does this make any sense? Is it anything other than speculation? Here's what it comes down to. I'm going to say something incredibly profound. You should write this down. Bitcoin does not have a value, but it has a price. We have to stop trying to figure out what is Bitcoin worth, because it's not worth anything except what people are willing to pay for it. I know that sounds kind of silly and incredibly basic, but you know the fundamental rule of investing. It's all about supply and demand. That's the beginning and end of it all. Now, you can call that a speculation. I wouldn't argue with you. I might debate it over a beer, but what is it worth? I don't know what it's worth. I only know what the price is. And here's what I mean by that. The maximum number of Bitcoins that will ever exist is 21 million. To date, about 18.5 million have already been mined. So we have 3.5 million left. Now, it's widely considered within the crypto community that about 4 million Bitcoin have been lost forever. And I know some of the people who have lost those coins, early developers back in the day. So due to, hard drives crashing, for losing passwords, people just quitting and giving up. So of the 18.5 million, there's about 14.5 out there now, 3.5 million to go. It is being released on a set schedule. The last Bitcoin will be mined in the year 2140. So we know exactly the schedule that the Bitcoins will be released. That's it. No more, no less. End of story. Which means if you want to buy a Bitcoin, you're in competition for other people who want to buy Bitcoin. It's like trying to buy tickets to a Bruce Springsteen concert. There's a fixed number of tickets. And if there's a huge demand, the price of those tickets is going to rise. And if nobody wants to go to the concert, the price of the tickets falls. Bitcoin is the very same thing. So let's look at the numbers broadly. There are 31 million millionaires in the world. If every one of those millionaires wanted to own just one Bitcoin, they can't do it because there's only 21 million Bitcoin. We have more millionaires than we have Bitcoin. If every endowment wanted to buy just a few Bitcoin, if every major corporation wanted to own as part of their cash reserves, their treasury stock, a little bit of Bitcoin, if everybody in the institutional marketplace, the pension funds and major corporate, if everybody wanted to buy just one Bitcoin, there's not enough Bitcoin to go around, and the demand will cause the price to increase. We believe in the crypto community that this is the main reason you are seeing the incredible increase in price over the past decade, an increase in demand. Is it legitimate? I don't know. Is it going to be sustained? I don't know. That's the speculative piece of this. It's quite possible that Bitcoin could be outlawed by government. China and India keep threatening to do that. It could be replaced by technology. Facebook is a big deal, but it used to be MySpace. Remember Betamax? Remember Blockbuster Video killed by Netflix? I mean, Bitcoin is the latest and greatest, but it could be replaced by the next big thing that hasn't even been invented yet. So competition could kill it. It could be technology that kills it. It could be, who knows what it could be. So it's still speculative in that regard. But at the moment, only 100 million people in the world out of 7 billion own Bitcoin. And this is why many regard the price will keep going up while the rest of us keep arguing over its value.
So classic supply and demand situation.
That's all I got.
And related to that, we have a question. Who controls the release of Bitcoin? You talk about the author of the white paper and kind of whoever is the wizard behind the curtain.
Yeah, it's the algorithm. This is the software that Satoshi wrote, which is very, very basic code. There's not much complexity to the code at all. And you can look at the code, just go to the blockchain itself and you can see it all. The software itself says that every 4 years, the number of Bitcoins you get as a reward gets cut in half. This is known as a Bitcoin halving. In the beginning, back in 2009, when you received your Bitcoin reward as a miner, you received 25 Bitcoin. 4 years later, that was cut in half to 12.5 Bitcoin. 4 years later, that was cut in half again to 6.25 Bitcoin. That's where we are today. There's going to be another halving event in 2024. There's a halving event roughly every 4 years. The last halving event was last summer, in May, June of 2020, when it cut it to 6.25. So in 2024, it's going to be cut again to 6.125. I'm sorry, 3.125. So picture you're a miner. You receive 25 Bitcoin as your reward. Suddenly, though, it's cut in half. And you're not getting 25, you're only getting 12.5. You're saying to yourself, wait a minute, my costs are the same. I don't want to cut and pay. When's the last time you were willing to accept a cut and pay of 50%? So the miners say, wait a minute, if you're cutting the number of Bitcoin I get in half, I want each one of those Bitcoin to be worth twice as much. So my pay doesn't get cut. And the general consensus is this is why Bitcoin's price keeps rising, to continue rewarding the miners at the same rate they were previously rewarded. The halving has the effect of providing price stability and increase because the supply drops, the number of Bitcoins being produced gets cut in half, while the demand increases. And every time, go look at the charts on the internet of Bitcoin halving, you'll see that every time there's been a halving event, there's been an exponential increase in the price of Bitcoin. This is why Bitcoin rose so dramatically last year, many will argue, because there was a halving event last May, and Bitcoin skyrocketed to 60,000. So it's just automatic in the software, and the halving event is why it's going to take to 2040 for the last Bitcoin to be mined.
And I think that answers kind of our most recent question, which is who are the they and why are they concerned about maintaining the reward of miners? But I want to come back to a question that came up a little earlier in the chat, and you alluded a little bit to the position that some countries in the world are taking, China, India, others, kind of opposing this trend. Do you have any more comments upon that?
Well, it's indicative of the fact that governments around the world are struggling to figure this out. And governments are always reactive, right? You know, we didn't build traffic lights until we had traffic accidents. We didn't have traffic accidents, so we had cars. So governments, by definition, are always reactive. That's not a criticism. It's, you know, they can't solve a problem until they know the problem exists. So governments have been having their fiat currencies forever. You know, all governments produce their own currencies called fiat currency, and everything's going fine from their perspective. Along comes Satoshi, who says, I hate this fiat system. Look at the 2008 credit crisis, all caused by the governments issuing massive amounts of currency, printing money to fix the credit crisis. And Satoshi said, we need a new solution. We need a currency that isn't tied to a government, that doesn't have runaway inflation as an issue. So all of a sudden, Satoshi comes up with a solution to something nobody knew was a problem. And with everybody getting excited about this and buying Bitcoin and talking about using it as a substitute for their local fiat currency, using it in transactions, using it anonymously where the IRS and taxation authorities can't track it, governments realize, wait a minute, I think we have a problem here. So some are trying to regulate it, like South Korea. Some are trying to ban it, like China, which is a relatively, as we know, oppressive government. Others are scared to death of it, like India. So they're all trying to figure it out. I'm a member of the Global Blockchain Convergence, which is an organization of about 180 lawyers from around the world. 2/3 of them are outside the US. This is a group of attorneys that is helping governments develop their regulations. To figure out, because there's some really serious issues here about regulation, about custody, about transactions. This is a global 24/7 asset. And if a country says no to it, like India or China, or restricts it, like South Korea, well, all they're doing is a disservice to their population, because it means everybody else is moving on with it. You know, China can restrict the internet access of its community. Well, nobody gets hurt except the people in China. North Korea can ban the internet entirely. Nobody's hurt except people who live in North Korea. It doesn't affect you and me. So instead of having 7 billion people dealing with Bitcoin, well, now we've only got 5.5 billion. So it's not a big deal. It's not an issue. And we think ultimately long term, they're all going to get in on it. They're going to realize that you can't stop it. You have no choice but to regulate it. You can't ban it, you can't restrict it, so you might as well control it. And that is what's happening now in the United States government. We've got Gary Gensler, the new chair of the SEC, who taught blockchain at MIT. We have the chairs of the Senate Finance Committee and Banking Committee and in the House Ways and Means Committee, all large Bitcoin proponents. You're seeing new regulations and new rules coming out of Congress and the Commerce Department and the Labor Department and the Treasury Department, all dealing with how do we get our arms around this. The Fed now has a chief innovation officer who used to be the head of digital assets at Charles Schwab, trying to figure out how do we get our arms around this? How do we protect our system? How do we protect consumers without having to say no? And this is why it's widely projected that by 2025, 80% of the world's population will be dealing with digital currencies. The Fed is creating its own CBDC. China has launched one, so has the Bahamas. Sweden is going to be next. Within the next 3 years, everybody is going to be launching a central bank digital currency. The attitude, if you can't beat them, join them. Because here's the bottom line why they're going to love it. Governments hate terrorism financing, they hate drug dealing, and they hate tax evasion. All of that occurs with paper currency because terrorists don't use Visa cards. Drug dealers don't use MasterCard. Tax evaders don't do any reporting of any kind. Well, digital assets leave a footprint, and it becomes very easy, much easier for law enforcement and the IRS to be able to track your transactions. That's why it's now the #1 question on the 1040, so that we know who you are. The IRS has successfully subpoenaed Coinbase and other digital asset custodians for the account info of their customers so that they can determine who isn't paying their taxes, because it used to be considered an anonymous issue. It isn't. It allows governments to regulate, and that means control, and that means mainstream. And this is why you have huge major corporations on Wall Street. Mass Mutual invested $100 million into Bitcoin. You've got BlackRock and State Street and many others engaging. The CEO of New York Life is now on the board of NYDIG. You're seeing this all over the industry as we recognize this is now legit. We want more regulation. We want the clarity. In other words, we're happy to engage, but we want to do it right. We want to make the SEC happy. We want to make FINRA happy. We want to make the IRS happy. And we want to make the state regulators happy. Just show us how to do it. Give us the rules. We'll play by the rules. Just let us know what they are. So I think that the nonsense we're seeing in places like India and China is going to dissipate over time.
Thanks, Rick. And you've touched upon a little bit of this. There were some questions about the anonymity. You said it does leave a digital footprint. So money laundering is not so much a question with respect to Bitcoin.
It's much, much more difficult. Look what happened with the Colonial Pipeline. The FBI grabbed it all back because they found the digital footprint and were able to steal it back. There are other digital coins that are more anonymous. You know what it's like with cybersecurity. Every time you build a 10-foot wall, somebody shows up with a 12-foot ladder. So there's always an issue in trying to deal with this. But the fact is, digital assets, digital currencies have a digital footprint. Cash doesn't. I don't know a babysitter in this country who pays taxes on her Saturday night earnings. If she's paid in digital assets, it all gets reported to the IRS.
That's a good point. Again, thinking about the scarcity, we're running a little close to time, but my interpretation is that every person's Bitcoin might be via an ETF, or what about the appropriateness? And you touched upon this too when you gave the portfolio allocation example. But what about the appropriateness of this largely speculative investment for the retail investor versus somebody who's got really, really deep pockets?
Yeah, if you keep it to 1%, whether you have 20 million or 20,000, 1% is 1%. And that's why the ETF is the holy grail. We would all agree that we would love the SEC to say yes to a Bitcoin ETF. Well, it's going to take a while. In the meantime, the price, may be a lot higher in the future by the time they say yes, so clients are missing out. So there are alternatives, and I went through a quick list for you today to illustrate that there are ways you can get exposure to the asset class. It might not be ideal, but it's better than nothing. It's not as cheap, might not be as liquid, might not be as transparent, but it's better than a zero allocation. So I would encourage you to engage heavily between the compliance department, the investment management department, and the investment advisory groups within your firms to figure out how to move forward in a manner that everybody's comfortable. There are ways to do that, and I'm happy to assist in that effort. My goal at RIA DAC is simply to provide you the resources, the information, and to serve as a resource for you in your efforts to navigate through this field, because it is new and different for all of us. And the certification program that we're offering, we're happy to extend within your organization as well through the IAA, so that we can provide you the training program without you having to reinvent the wheel. This isn't a very complicated conversation. And we've nailed it in terms of the education and content to help you figure out how you can proceed in the marketplace. And I'm happy to help you do that. Feel free to call on me anytime. You can reach me through Nancy or directly at RIA.
That's terrific. And this has been a very quick hour. Appreciate everyone's participation and very much appreciate that opportunity to extend a discount to our members. As Ric mentioned, for the certification program, I've actually started it myself and I'm really learning a lot. So we will be in touch about that in the coming weeks. And in the meantime, Ric, thank you again. Thanks to everybody for joining us.
Thank you, Nancy.
Take care.